All right, let's cut right through all the noise. When it comes to financial analysis, forget about trying to learn hundreds of complicated metrics. We're going to give you the only 7 financial ratios you will ever really need to understand pretty much any business out there.
You ever look up a company's financials and just feel completely lost? It happens to everyone. You're just staring at this wall of numbers and you're thinking, what on earth actually matters here?
I mean, there are literally hundreds of them, mountains of data, and so much jargon it could make your head spin. But here's the secret, okay? You don't need all of that. Not even close. You just need these 7 to get a really powerful, clear picture of a company's health.
Okay, so let's dive into part 1. We're going to start with a few ratios that are all about answering one simple question. Is this a high-quality business that actually knows how to make money?
First up, we have return on invested capital, or ROIC. Now think of this like a company's report card. For every single dollar it invests in itself, whether that's building a new factory or creating new software, how much profit does it spit out? You're looking for a number over 12%. That's a great sign that the business is creating real value.
And here's why so many people think it's the single best measure of quality. Unlike a lot of other metrics, ROIC is really, really hard to fudge with accounting tricks, like loading up on debt. It gives you a true, unfiltered look at how well that core business is actually performing. Number 2 is free cash flow. This is not some abstract number on a spreadsheet. This is the real, actual cash left in the bank after a company pays for everything, all its expenses, all its investments. You know, a really strong company doesn't just have positive free cash flow, it has growing free cash flow. And this is just so critical. Look, reported earnings can be shaped and massaged through all sorts of accounting choices, but cash doesn't lie. If a company claims it's super profitable but it's constantly burning through cash, this is the number that will call its bluff.
And our third quality check is the gross margin. This tells you how profitable a company's main product or service is. So after they sell something and subtract the direct costs of just making that thing, what percentage is left over? That's your gross margin.
And what this really reveals is pricing power. A high gross margin is like a financial shock absorber. It means the company has a nice buffer and can handle rising costs without getting its profits totally wiped out. But what's really important here is the trend. Is that margin getting bigger or smaller over time?
Okay, great. So we know how to spot a quality business. But even the best business can be a risky investment if it's not financially sound. That brings us to our next set of tools, which are all about assessing safety and risk.
Our first risk metric is the debt-to-equity ratio, and it answers a really simple question. Is the company running on its own money, or is it funded by a whole bunch of loans? For most industries, you want to see a ratio below 1.0. That's usually a sign of a pretty healthy, conservative setup.
The reason we watch this so closely is because debt is a classic double-edged sword. You know, when times are good, it can totally supercharge returns for shareholders. But if business slows down, whoa, those same debt payments can become a massive weight that can drag a company down.
Next up is the current ratio, and this is the ultimate short-term survival check. It basically asks, does the company have enough cash and other stuff it can sell quickly to cover all its bills for the next year? Ideally, you want to see a number somewhere between 1.5 and 2.0.
And this is such an important point. Seriously. A company can look profitable on paper for years, but if it can't make payroll next week, it's in deep, deep trouble. The current ratio is your early warning system for exactly that kind of cash crunch. All right, so we've covered quality, we've covered safety. Now for the final piece of the puzzle. What's it worth? We're going to look at valuation and then wrap it up with an awesome all-in-one health score.
So you've probably heard of the PE ratio, or price to earnings. It's kind of like the market's mood ring for a stock. It tells you how much investors are willing to pay today for every dollar of profit the company makes. A high PE usually means people expect a lot of growth, and a low one, well, not so much.
But, and this is a huge but, please do not fall into this trap. A low PE doesn't automatically mean a stock is a bargain. Sometimes things are cheap for a very good reason, like the business is falling apart. That's why you have to use this with those quality checks we talked about.
And that brings us to our 7th and final metric. This is a fantastic all-in-one tool called the Piotrowski F-score. It's a simple checklist that grades a company's financial health on a scale from 0 to 9. Super simple.
And here's a peek under the hood. The F-score isn't some random number. It's the result of 9 simple yes or no questions covering all the things we've been talking about: profitability, cash flow, debt, and efficiency. It really just answers one thing.
Is this business getting fundamentally stronger or weaker? This score tells you in a flash.
And the scoring is so easy. A company that gets an 8 or a 9, it's in excellent financial shape. A score of 4 or below, though, that's a red flag. It suggests you need to dig a lot deeper and figure out what's going wrong.
So, let's put it all together. This is it. This is your toolkit. 7 ratios that give you a complete 360-degree view of a business, from its quality and risk to its valuation and overall health. When you use them together, they tell a really powerful story.
Now, this entire framework actually comes directly from the team at fffinstill. They're the ones who boiled it all down to these 7 key ratios. And on their site, you can actually see all of this calculated for thousands of different companies. It's pretty amazing.
Honestly, if you found this helpful, I really think you should go check them out at fffinstill.com. That's fffinstill.com. They've got a huge library of over 300 free learning concepts just like this one to help you become a smarter, more confident investor. Definitely go give them a follow.
So there you have it. You now have the 7 essential ratios to truly understand a business. The toolkit is officially yours. So the only question left is, which company are you going to analyze first?